So, have you ever opened up a company's annual report, all ready to do your homework as an investor, and then you stop because you're staring at two different profit and loss statements? It's a super common point of confusion, but honestly, understanding the difference is one of the most important things you can learn. Today, we're going to crack that code.
Right, you see one statement labeled separate and another one called consolidated, and they often have completely different profit numbers. So what is going on here? Is the company trying to pull a fast one? Nope, not at all. There's actually a very logical reason for this, and once you get it, you'll have a much clearer view of a company's real financial health.
Okay, so to solve this little mystery, we first need to get one thing straight. In the business world, companies aren't always lone wolves. They often own pieces of other companies, creating this whole kind of corporate family. And the way these relationships are structured, well, that changes everything. So at the very top of this family tree, you've got the parent company. You can think of it as the headquarters, the main business that holds the controlling stakes in all the others. It's the big name on the annual report you're reading. Now, if that parent company owns more than 50% of another company, we call that second company a subsidiary. And that more than 50% number is absolutely key because it means the parent has voting control. It's calling the shots for the subsidiary. And what happens if the ownership is less than 50%? Well, then we call it an associate. In this case, the parent company doesn't have total control, but it owns enough of a stake to have what's called significant influence over that company's decisions. So let's just nail this down real quick. 100% ownership, that's a wholly owned subsidiary. More than 50%, that's a regular subsidiary, and that means control. And then under 50%, that's an associate, where they have influence but not the final say. Simple rules, but they have huge consequences for the numbers you see. All right, that's the textbook stuff. But, the best way to really get this is with a story. So let's make this real with a quick example. So let's meet our main character, Company A. It's a successful textile business, and it's sitting on a pile of cash, 200 crore to be exact, and it's decided to expand by investing in some other companies. So, Company A goes on a little shopping spree. First, it buys all of Company B, another textile company. Then, it decides to diversify and buys a controlling 51% stake in Company C, an IT firm. And finally, it takes a smaller 25% stake in Company D, which is in the electronics business.
And boom, just like that, a new corporate family is born. Company A is now the parent, Company B is its wholly owned subsidiary, Company C is its regular subsidiary, and with that 25% stake, Company D is now its associate. See, our three definitions are now playing out right here.
Okay, now that we've got this whole family of parent, subsidiaries, and associates set up, we can finally solve our original mystery. Why in the world are there two profit statements?
This slide is the key to everything. Just think of it like this. The separate statement is like looking through a microscope. It only shows you the performance of the parent company. So in our story, just Company A's textile business. But the consolidated statement? That's like looking through a telescope. It gives you the big, wide-angle picture. It combines the financials of the parent and its subsidiaries, so companies A, B, and C, and presents them as if they were one giant company. And notice, Company D, the associate, isn't in there. That's because Company A doesn't control it, so its finances are handled differently.
Let's actually put some numbers on this because this is where it's all going to click into place. We'll just focus on the parent and one of its subsidiaries to see exactly how this whole consolidation thing hits the bottom line. Okay, so let's say Company A, our parent, made a solid 10 crore in profit just from its own textile operations. This is the big number you'd see on its separate profit and loss statement. Meanwhile, its subsidiary, Company C, the IT firm, also had a fantastic year and brought in 5 crore in profit all on its own. So now for the magic. Because Company A has control, their results get combined or consolidated. You literally just add them up. That 10 crore from the parent plus the 5 crore from the subsidiary gives you a total consolidated profit of 15 crore. See? You're not just looking at one company anymore. You're seeing the true economic power of the entire group. So this all makes sense in our little story, but how do you use this when you're looking at a real annual report for a company you might want to invest in? Where do you find all this info? It's actually a lot easier than you think. Just dive into the annual report and look for a section called Notes to the Consolidated Financial Statements. Almost every single time, right there at the beginning of that section, the company will give you a list of all of its subsidiaries and associates. It's basically your treasure map to the entire corporate group.
So let's just wrap this all up. Here's what you really need to remember. Those two statements exist simply because of that parent-subsidiary relationship. The separate statement is for the parent company all by itself. The consolidated statement combines the parent with all the companies it controls. And here's why it matters so much to you as an investor. The consolidated statement gives you the real picture of the entire group's health. You could have a parent company that looks profitable, but it could be hiding massive losses in its subsidiaries, and that's a huge red flag you would totally miss if you only looked at that separate statement.
So the next time you open an annual report and see those two statements, you won't feel confused. You'll see a choice. A choice between the story of just one company and the story of an entire corporate empire. So which statement will you look at first?